this all started for me. So as I mentioned to you, I'm always a believer that chaos creates opportunities. So I'm already excited. I'm already seeing this as a buying opportunity. But having said that, you can't just say, oh, well, this is a bunch of crazy stuff. Let me throw some money around and expect to be successful. You have to find the niche. You have to find the loophole within that chaos and within that structure to say, where is it going? Am I going to be able to be prosperous from this? And you guys who know me know I never try to make projections on appreciation. It's not something I do. I don't think, maybe that's because I'm kind of a child of the last crash. I came up in real estate during that. When I heard so many, supposedly smart people projecting equity appreciations to me, and 100% of them were wrong. So for me, I try to focus on the things that I know are true, which is cash flow. Cash flow, if you base your strategy on creating a high cash-on-cash return instead of equity appreciation, the nice thing about that is, as you probably heard me say a lot too, if the market crashes, not only are you covered, but it actually helps you. For example, if I buy a property for $1 million cash, we'll just use round numbers, and I'm getting a 20% cash-on-cash return. So the net income I'm generating on that $1 million purchase is $200,000 a year. If the market crashes, and now that same building is worth half of what I paid for it, I'm happy. And the reason I'm happy is because now I can go buy one just like it for $500,000. And now I'm going to get a 40% cash-on-cash return because as we saw in 2008, 2009, 2010, so on during the last crash, while the values of properties went down 70 to 90%, the rental rates largely remained the same, or in some cases, they actually went up a tick a little bit there because you had many foreclosed homeowners being influxed into the rental market that used to be homeowners, now they're renters. So having said that, just with that alone, just with the cash flow strategy that we use with Vacation Wealth Partners, I'm already excited. But then I started thinking about it, and it all started because someone posted something about the average home price and the average gold price in 1962, looking at inflation rates. And I started thinking, there's two things. While I don't like to project appreciation of equity and value, I do like to project inflation rates because that's something that's tangible, it's factual, and it's happened since the existence of our country. So I started looking at it here. You can see back in 1962, the price of gold was $35 an ounce at the close. Today, it's about $1,900 an ounce at the time that I'm making this. Okay, 1980, that jumped up to almost $600 an ounce. So I'm going to go to the average home price in 1962. Actually, that's not the right one. Here's the one I want. The average home price in 1960 was $11,900. That jumped up by 1980 to $47,200. Up to about 120,000 in the year 2000. And as of 2020, from the statistics that I looked up, it was up to about 148,000 for the average home price in the United States today. So both of these things are obviously, both gold, precious metals, and real estate are incredible hedges against inflation. But then what really jumped out at me when I look at these numbers is I said, obviously over the last 50 years, 60 years, these rates of return are massive. But then I looked at what the price was for gold in 1980, and I said, well, 600 to 1800, that's a 3x return over 40 years for gold. That's actually not that significant. It's really not. But then the reason that I've got this jumped out so much, 1970 said, look at how much it jumps in this 4-year period from 1976 to 1980. 160 all the way up to 600. So that's about a 450% increase over those 4 years for gold, which in my opinion is gold and real estate, but slight edge to gold are the main indicators of true inflation rates. Now I wanted to see if it was the same with the housing market. So when I go to the housing market, you can see huge jump from 1940 to 1950 percentage-wise. About 250%. 1950 to 1960, about 40-50%, still all big gains. But look at the gain from 1970 to 1980. It's almost triple, from 17,000 to 47,200. And those of you that were alive back then already know what I'm about to tell you. Those of you that weren't or weren't paying attention, what happened from 1976 to 1980 was Jimmy Carter and some of the highest interest rates, highest inflation rates that we've ever seen. And I don't know 100%, but I think it was the highest inflation rates, highest interest rates that this country's ever seen, which, by the way, was part of what gave birth to owner financing as a strategy, because people couldn't qualify with the banks with these 16, 18, 20% interest rates. So they say, hey, I mean, I just can't do this. It's going to be idiotic. Well, can I buy your property and you carry a note at maybe 10% or 11%, whatever it was? It's still a better deal than these obnoxious interest rates people were paying. Then things started to get back to normal in the 80s, 90s, 2000s, and we actually even saw some deflation happen during those periods. So the reason why this is important to me, the reason why this is such a good indicator, is think about what we've been through and think about, with all the negatives that have happened with the pandemic, where's the potential positive there from an investment standpoint? We've printed trillions and trillions of dollars in aid, and we're about to print trillions and trillions of dollars more in aid. Logically speaking, that creates obvious, almost instantaneous inflation. And I'm not saying that we shouldn't be doing that. We need to do that. People need assistance. There's people out there living in cars on the streets. There's small business owners that are going bankrupt. There's restaurants, workers and owners, entrepreneurs that had their dream. And my gosh, if you started a restaurant in 2019, 2020, I can't imagine. You know, and even us in the vacation rental sector, you know, we have vacation rentals were illegal for 3-4 months this year, which obviously had a negative impact on us. The only reason that I'm thankful we're blessed to still be here and doing well is because we based our strategy on these fundamental principles, and we put safeguards in place with reserves to protect ourselves. But it's not enough to protect yourself. You know, you don't want to just survive and limp through this thing. You want to actually find the opportunity before anyone else does, and you want to be able to capitalize on it fully. And once I started looking at these numbers, again, already being excited and knowing that there's going to be some buys out there because of the obvious reasons that you probably already thought about, most of the people on this call. Some sellers are going to be more nervous than others. Some people are going to be thinking a crash is coming, so on and so forth. You're going to get those buys, and that's fantastic. But this actually genuinely could, when you factor in the combination of fear in the marketplace on the seller side with the amount of trillions and trillions of dollars of paper money that we have printed and will continue to print in upcoming, you know, the upcoming 12 to 24 months to survive this whole thing, you could see the most rapid inflation that this country has seen since 1977, 78, 79, and 80. Right now is the time to buy. You know, if you buy a property today, let's just go back to this average home chart here. If we bought a property and we experienced them, just because I like, let's get some factual exact numbers here. If we bought a property for $17,000, okay, so that's 3.6. Okay, I did that backwards. I apologize. I should have probably done that before. Anyhow, so that's a 277% return if it mimics the rates from back then. So I'm not saying that that's going to happen exactly, but you get the idea that that's the potential opportunity that lays in front of us, to where, especially if we're already utilizing leverage to create a high cash-on-cash return. So we don't really care what the property's worth. The property's a vehicle to create income and revenue for us on a monthly and annual basis, right? And the value then becomes secondary, because it only matters what it's worth at the time we buy it and the time we sell it. And if we're earning 15, 20, 30% cash-on-cash returns, why would we want to sell it anyway, right? But even aside from all that, let's say that we buy a property for $1 million. And then if we get half of this return, half of this appreciation due to inflation that we saw from 1976 to 1980, that's 135% equity appreciation over a 4-year period. which is obviously substantial. So now our property that we bought for $1 million now worth $2.35 million, plus, just for round numbers and for fun stuff, if we were earning an average 20% cash on cash return, let's add that to it and make our overall return on an annualized basis somewhere between 60 and 90%, which is obviously insane. I'm not saying that's going to happen. Obviously, nobody knows for sure, but I'm telling you, if you look at all of the math and you look at history, and history usually does repeat itself, the factors line up for this to be, in my opinion, one of the best buying times that we've had. It's certainly since the last crash in 2008, 2009, and, potentially since, 1977, 78. What you don't want to do is wait and be in a situation where you're seeing the margins rise and you try to get in 2022, 2023, and you miss the boat, because at some point, just like how it always goes back up when it comes down, it always goes back down when it comes up to some extent too. And somebody gets caught holding the bag there, which actually, as many of you might know, happened in the crash in the early 80s there, and then again in the early 2000s, and then again in 2008. So you don't want to be holding the bag there, but if you use fundamental strategies, utilizing leverage, base your strategy on creating a positive cash-on-cash return. I always say the purchase price matters the least to me in any negotiation. It's all about what we can get on an interest rate, interest-only amortization, which again creates higher cash flow, which creates a higher cash-on-cash return, and setting ourselves up to where you genuinely do not care what that property is worth until the time when you go to sell it. And again, why would you sell it if you're earning a 20% return on it? So I will say too, though, if you're utilizing leverage, and if I am correct that we're in a position where we could see rapid inflation here, that also will give you an opportunity to then pull cash flow out, because now you're going to have additional equity and spread that around into more properties, creating more income, which counteracts the inflation, because obviously everything's going to be more expensive if it goes that way too. So that is something to think about. But in my opinion, and the opinion of those that I respect and trust closest to me, this is one of the best times in our country's history to buy tangible assets. And that's not only real estate, that includes precious metals, gold, things that are going to hold their value, things that are going to counteract inflation as it continues to rise. So I hope that adds some value at least to someone, or at least makes you think a little bit. Of course, do your own research. Truly thankful to you guys. It's an honor to have you in my network. I'm thankful that you take the time to listen to these webinars. It's our greatest mission to add value to you, and I hope that in some small ways we do that. So